Good afternoon, ladies and gentlemen, and thank you, Business World, for inviting me as a moderator on this insightful panel discussion on CFOs on the policy front, navigating compliances and regulations. As we speak, we all know that we are at a moment of time when the things are moving at a much unprecedented speed, where the role of CFO is no longer the financial insights. It's more about strategic, how they are handling the policy changes, the regulation, compliances, while maintaining the core and sustainable business value. If you know all about the changes which are happening, right from the global tax changes, tariff changes, ESG compliances, cybersecurity, and last but not the least, AI regulations. We have never seen the way the things are evolving and at an unprecedented speed. Now, what are we expected from the CFOs? CFOs were doing very strong control onto the balance sheet and onto the strategic management. Now they are expected to navigate themselves, not only themselves, and also to the organizations for this unprecedented changes which the world is seeing and which we all going through as we are moving ahead in our life. With this powerful topic, let me just start the discussion with my esteemed panelists, and we'll take across their views, how they are handling in their respective roles with the changes which is happening at the global level, and while ensuring that the stakeholder interest is always at the forefront. So I'll start the question with Pranav on the global tax reform changes.
That's a very valid point that you made, ma'am, that unpredictability is now the new normal, and we all have to face disruptions now, and we have to prepare for disruptions with the pace of development that is happening. I mean, on a daily basis, we see a lot of amendments happening in various tax provisions, both in India and in abroad. So just to give 3 examples, which off the top of my mind, first is BEPS Pillar 2, which is a very significant reform which has taken place in the last few years, where they have talked about a minimum global tax rate, and the home country or the under-taxed countries have to top up to meet the tax requirements. So that sort of necessitates, basically it will impact MNCs having a global footprint. They will have to sort of do a tax risk assessment. They will have to assess their global tax positions. They'll have to see the minimum tax requirements which are required. And also they'll have to also align with their investment strategies, because with the fast pace of development and the ever-changing requirements, it becomes very critical. Secondly, in the field of, say, double taxation agreements, DTA, even recently India has signed an agreement with Oman. Now, while the developments are happening, the one good thing is Indian government has also streamlined a lot of things. So in DTA, we see that a lot of things regarding, say, royalty or FTS or IPR or software, a lot of things have been streamlined. And while they have brought in some good sort of changes on documentation, like for example, you have a tax residency certificate, or you have an OPE declaration, then you will have withholding taxes which are sort of normal. So that would help in negotiations also with the parties, especially when the dispute is about whether you bear the withholding tax or whether you pass it on. And last, of course, is the tariff volatility. We are in the midst of economic wars and military wars as we speak. And economic wars, what has happened is global supply chains have been impacted across the world. Pricing has been impacted across the world. So I would think the need of the hour is for a very responsive supply chain, which has to be agile and which has to be adaptable. Because now when we do predictive modeling, it has to be scenario based. We have to take into account what will happen, because there will be impact on currency risk, there will be impact on your hedging strategies, your investment strategies. So a lot of things will get impacted because of that. So I think when we look at tariffs also, we have to look at, for example, say some geography was a very attractive destination, where we all say China is the factory of the world. But today, because of tariffs, it no longer may be an attractive destination. India is becoming much more attractive. So I think we have to have our strategies that are very flexible and which take into account the ever-changing scenarios. And to round this off, I may say automation is an imperative, because at least the repetitive tasks, the manual tasks, they can be taken care of and we can focus more on strategies. And also one important thing is advocacy. while the changes are rapid, the government has been very receptive when we do advocacy. They have been listening to us when we go to them with ticklish issues. They have been addressing our points. So advocacy becomes an important factor when we actually want to address some of the issues with confidence. So this was my take on it.
Thank you so much. I think Pranav touched upon all the three important points. Is you have to be agile. You need to have the automation in place. You need to be strategically updated on what changes are happening, and without the advocacy you can't just have the things, and making sure that if things are not working well for you, step up and go for the advocacy. Thank you so much, Pranav. Let's go to the Sandeep, and wanted to understand about the whole international disclosure mandates. What's the role CFO is playing in aligning financial reporting with ESG, DI and international disclosure norms?
Thank you, Upma. So ESG and all these reportings are the talk of the town now, and every organization need to report in either category 1, 2 or 3, depending on their size and SEBI mandates for those entities. But what we are looking as a company is basically market is moving more toward integrated reporting, which is basically combining the 6 capital framework, which is a human capital, financial capital, or a natural capital, IP-led, technology capital, manufacturing capital, and the last one is social and relationship capital. So all these factors need to be embedded in your integrated reporting framework, and this is what we also are doing in Protean, and we are preparing for that. And when we started this project, we thought it will be moderately or moderate difficult, but I guess it is very difficult project for us, because you need to have a hell lot of data before you start putting that report. So year 1 will always be a journey, right? So we need to collate a lot of data surrounding these framework. As an example, for an IP or technology capital, how much you are spending in your R&D, which is not a simple thing that you will get. You just calculate number of engineers and multiply by but you need to really see what is going into the real R&D, and then you need to report, rather than doing greenwashing, which is many organizations also does, right? So that is not the idea. Idea is to give accurate reporting to the extent possible. Same way, when we go to diversity, you need to collect so many data points, right? What is the ratio? What is the average age? What is the male-female ratio? Are you recruiting? Are you becoming more diversified? And all those. And then another aspect is natural capital, which is CO2 emissions and all that. You need to collect data not only for your organization, but also for the major partners of your organization when you are going into phase 2. So which is also a very difficult exercise, and humanly I would say it is not possible. We need to deploy some kind of tools and technology wherein people can feed in data. For year 1 it may be a more manual half tech, half manual exercise, but from year 2 onward you have to have a better discipline or governance in the place, so that you can get all the data all the time, right? It is not like a yearly reporting. Rather, you should you should maintain that discipline in the ecosystem of the organization, so that you get this data every month or whatever period of frequency you decide, and then you need to present this data to board also. Board also need to approve. So a lot of processes are also involved, and you need to see that the governance are taken care, and whatever data you are putting in your reporting framework is reliable and accurate, so that you can really depict the
Yeah. Thanks, Sandeep. But would you like to also talk about, you're talking about the non-financial data, and data collection is one of the challenges, and how the organization need to prepare themselves. But how is the overall understanding of the stakeholders? It's not just the reporting part of it. We're investing it with the purpose. So how are you navigating the whole, involving the stakeholders, including your own team, getting a sense of it, what we are doing, it has a purpose?
So in our organization, we are having a lot of sessions on these topics, be it admin, HR, because a lot of data come from these support function, technology and all that. We are giving a lot of training. We have appointed a consulting firm, to give this knowledge, about all these ESG and integrated reporting, 6 capital framework, and we are collating data. We are basically, making people understand, to the last level that this is what we need. If an employee, let's say, is using an electric car, we would rather need the data every day, how much carbon, footprint he is saving, basically. So this is all about, training, discipline, technology, use of technology. We are putting internal tools also, by which, employee can simply, put the data, and then we can collate the data.
Excellent. I think that's a great initiative which you and your organization is doing. Now let's go back to the very favorite topic of automation, and I want Vimal to talk about more onto the automation. How is this? How are you leveraging automation and the analytics to streamline reporting in the multi-regulatory environment? The things are changing, and without automation, I think we just can't live. So, would you like to talk about your journey on the automation?
Yeah, thanks. Thanks. Yeah, it's a hot topic today. Automation, AI. Everybody's talking about it. So, like today's world, the CFOs are facing a lot of challenges. Multi-regulatory environment where you have a tax jurisdiction overlapping, you have a SOX compliance, you have ESG compliance. It's a lot of things where reporting has to be done. So automation and analyticals are the two enabler for CFOs to do that. And how it helps? It helps in your correct regulatory requirement handling and the efficiency in the system to report correct data. So there are 6 to 7 pillars which you have to use, is like where various points where you have to use this automation. One is your regular reporting of statutory and financial reporting. The other one is your consolidation. Today you face, if you have a national company where you have to do consolidation with this, so that is where another area we have to use. ESG reporting, like as mentioned, that is where like most of the companies are struggling to get the data. That is, and tools are available, but the correct data capturing is not happening. A lot of places you are still using the assumption to capture the data. The compliance metrics. So I'll give you example. We are into a manpower industry, facility industry. So the biggest challenge is to have a minimum wages compliances. And we are using tool to identify every month which are the sites where we are not compliant. So immediate action can be taken. That is one of the key enabler for us in terms of compliances, because the moment we are non-compliant, it is like client is also at the risk and we are also at the risk. So every state has a different category of wages. So we have a tool which identify, once the salary processing happened at first level, it identify and throw the report that which are the sites which are not compliant. So we can take action before we do a payout. The other thing is we use a lot of APIs, and that is also because in your financial system you cannot develop anything. So you have to use a lot of API. So there are different tools available, which is like your financial system in the center, and then different application which you have to integrate with API. One more thing which like taxation also, I'll give example, GST, we use one tool which is integrated with our financial system. So the reporting happened with the tool, but the updation data is taken from because invoicing happened in our ERP. And the key thing for any development to do this, you have to work on master data. So how your vendor master, material master, client master, the data capturing happen, because it is the base of anything where the data flow will happen. If those data are not correct, then it will create problem in your reporting. So you have to start base from the data correction at the master level. Once that is done, then you can think of API and the consolidation.
Thank you so much. Anybody else?
Yeah, just to add on, one angle of, automation is how do we improve the compliances. But the bigger, I think, area where organizations are focusing is how do we get the efficiency and productivity going up. A lot of times what happens, and I have seen it over many years, and when we started career, probably that time also automation existed. ERPs were coming up, manual work was getting eliminated. And now we are at a era where majority of the financial systems are automated. Nowadays, no one posts actual entries. Most of the entries flow from business automatically. You have to review it. Now, from here on, what efficiency you can bring in? So the efficiencies are coming from the peripheral systems, whether it is operation systems, supply chain systems, Salesforce automation, Uh, I'm from FMCG industry and majority of my career has been in FMCG. The biggest area where we work on is consumer insights. How do we get consumer insights in a much more efficient way, because consumer is changing every day. Your channel of distributions are evolving. 10 years back, general trade used to be a biggest channel of distribution. Today, e-commerce and quick commerce have taken more than 25% share. So what are the evolving trends of consumer behavior? How do you stay relevant? And when you become customer oriented, a lot of automation is required. For example, e-com and modern trade or quick commerce. The data is humongous. Earlier you used to have 100 distributors. Now you are practically dealing with more than 1 million customers who are shopping online. So how do you integrate all of this in your system to ensure that your reporting is on time, you get real-time data access, you make right insights from it. And that's where I think the world is now transitioning. So ERP and financial system to a large extent are automated, but these are the peripheral systems. How do you automate them faster so that you draw more and more efficiencies from them?
No, very well said. And I think both Vimal and Nikhil, you raised the very valid point of, Vimal talked about, have your basic systems in place while peripheral systems are required. But if you're not capturing the right information, you will not be able to make the full use of the automation. And what you talked about is of the customer insights and all. It's not just the financial reporting. And the things and the world is changing so fast. If you'll not listen to your customers, you will perish. So that's something which is, which the automation and the way everyone, it's not only the FMCG, I think every industry is being taken care of these two things. With this, I'll move to the next topic, and I'll request Nikhil to chip in this particular question is how CFOs balance risk, capital and purpose in the volatile policy landscape.
Yeah, so lot is changing and lot is still remaining the same. So, when we started our careers, probably all CFOs were viewed as value protector, custodians of the asset. From there on, the world has changed now where CFOs are expected to add a value. So we are no more just value preserver, but we are value creators in the organization. And just by being in a position where we have 360-degree view of the organization, who else is placed better than a CFO to create that value? Now, all of us must have seen this recent incidents of AI 171. From takeoff to crash, it was 54 seconds, less than a minute is what pilot got, which means that the reaction time was very, very less. But had the flight been at 30,000 feet altitude, probably pilot would have got 7 to 8 minutes of reaction time. Same is happening today in our business world. If you have a longer runway, if you have a higher altitude, your reaction time is much more. But if you are getting a very short reaction time, possibly, it is fatal in some of the businesses, especially the startups or growing organizations which are stressed for cash. So as a role of a CFO, I think in an ever-changing world, whether it is policies, geopolitical issues, changing dynamics in the world, changing consumer behavior, everywhere, everything is changing so rapidly. So you have to build a very resilient organization. And resilience comes from every function. Our friend talked about resilient supply chain. You have to create multiple options, reactive supply chain. You have to understand your consumers very quickly because their behaviors are changing. Similarly, technology from manufacturing side is also changing very rapidly. So you have to be very aggressive on cost, you have to be best in cost, you have to provide the best product and service to a customer. And while doing all these things, you also have to remain relevant, which means that how do we build resilience in the organization and how do you influence every function to create that resilience within themselves. So as an influencer, we have to create that role and we have to do that job very well. Now, what is value creation in this entire space? Value creation is basically you have to add value more than your cost of capital. And as a co-pilot to the business, our role is to optimally allocate our capital in a way that our returns to all stakeholders keep increasing and they are benchmarked to best of the best in the industry. So while doing that, I think I will go to the fundamentals again. So as I said, lot is changing, but lot is still same. And somewhere we have to refocus our energy in looking at it in a much sharper way. So when it comes to capital allocation, every organization will have their strategic priorities. The strategic priorities is a very nice term, but most of the times in organization, the confusion is at strategic priorities. Manufacturing will think that manufacturing is a strategic priority, sales will think that sales is strategic priority. So creating that clarity in organization and staying true to those strategic priorities is fundamentally a job of a CFO to align every function and even the investors and the board. Because board could have a different point of view, investor could have a different point of view, while from what is right for a business could be completely different. So how do you influence and create consensus for that long-term strategy and a short-term strategy is critically important. Because if that clarity is not there, you will allocate a capital and then you will have to retract it back. I have a small example to share. Our sales team used to be very bullish. I'm talking about one of the organizations where I've worked. Very bullish to the extent that we went and created a huge manufacturing facility, single site manufacturing facility. And by the time facility came on shore, the business had started tanking because of multiple reasons. Now your capital is allocated, you have an ideal site sitting there because of the fundamental error of you have not done sensitivity, you have not taken into consideration if business tanks, what will happen. So I think when that kind of a situation come, again CFO's role is to monetize that asset, not sit onto it. You will have brands, you will have facilities, or you will have assets which are not yielding results or ROI to the extent you want. So monetization is also an option which CFOs should explore. So fundamentally, again, to summarize, if I have to say, I think building that resilience in the organization is critically important. Clearly define your strategic priorities and start allocating capital to those priorities after doing sensitivity analysis, after guardrailing your investment, so that in future you are not sorry for the decisions you've made.
Very well said, Nikhil. And on the resilience part, and what I get a key takeaway from him, you're taking an action. Not all the actions can be 100% correct. Sometimes you may go wrong. Do not hesitate. Take action to wind it up and whatever required to be done. You should feel proud. At least 99% of the actions which you've taken has gone wrong, and even if 1% not gone wrong, we remain bold and accept the failure and then get going. From the resilience, I'll just now go back to Yogesh, and he's also been handling the highly regulated environment. How are you preparing yourselves to mitigate the risk? Because with the resilience, the risk is coming at the forefront. Mitigate risk, and how do you plan for ensuring that there is a rail guard, always for the businesses to take care of the risk?
Thanks. Thank you. So, by my experience, what I have seen, that though as a risk is a primary function could be assigned to a CRO in many entities, or rather in the NBFC sector, but CFO is always at a center of when it comes to a risk management, so the primary responsibility is generally shared, and risk, what I have seen, is a more of a collaborative function than a individual specific to any individual. When it comes to a risk management, so there are primary two risks. One is a regulatory and compliance risk, and second one we call as a business risk, which can cover all types of risk, be it an operation risk or other. stakeholder or a promoter, they are very, very sensitive to a regulatory and compliance risk, and their expectation, they have a very high expectation, or they always CFO have to take care of both the risk is what. So when it comes to a regulatory compliance risk, I would to in our company or in sector parlance, when it comes to an NBFC parlance, the primary risk could be, you can classify as one is a liquidity risk, which you anyway, which many companies quite manage effectively. So we are, but when it comes to a compliance risk, we have seen an example in our entity that you have to give directions to the business to make changes in their business model, in their sourcing model. Like we are in housing loan, housing loan company, so where if we feel that our lab portion is going significantly, we have put a stop to the business. We have taken that decision, and we have seen that our promoter have also supported that decision, that if we have to stop some business at some point of time, we have to do that. So that comes to, when it comes to a business risk, as I said, it's being a collaborative work. We have in our entity, what we do, we have a risk committee, internal risk committee, which we meet every month. Also, apart from that, we have a multiple layer reviews, like, I mean, we have a quarterly, annual reviews of all the risk, what we have identified, where we have fared. We have a risk tolerance level which we have defined, and then every department has to work within that overall risk tolerance level which we have taken, we have agreed, and which is even approved by our board. So this is how we generally are managing our internal.
Yeah. Thank you. Thanks. I think what I get a key takeaway is be proactive. You have your risk thresholds, but if the things are moving not in the right direction, go back to the businesses and talk to them and ask them to make the business model changes rather than just sitting on to the risk which is not worth taking the risk. With this, I'll just make it as a rapid round and try to, I mean, not more than 2 words or maximum a sentence to everyone. How do you like to keep the fine equilibrium between shareholders' return and the multi-regulatory environment? Not more than one statement.
So map the compliance metrics to your business KPI. That is the thing you can, so shareholder also get the return, and then you are able to manage the regulator.
Excellent. Yeah.
I think, I guess, regulatory compliance should be part of your strategy. It is not a cost center. If you non-comply, the reputation risk, the cost of, correcting the non-compliance is very heavy in today's world. So I guess you need to be very sure of, whatever you are doing is you are complying with the law of the land in whichever geography you are operating, and it has to be part of your strategy.
Yogesh.
No, as one of our board of directors says, that he says, in today's world, you have to first be compliant, then do business. Is what we.
Great. Nikhil.
I think I will go back to, build resilience and agility in the organization, and as a CFO, have a very clear communication between multiple stakeholders, because everyone has different priorities, and create consensus, because that's your job.
Pranav.
My take on it is try to achieve a balance. So on the one hand, compliance is a must. The job of every tax head, as one of our directors had put it, is to keep them out of jail. So that is critical. Having processes and controls is equally critical. But having said that, also be proactive enough to sort of understand the environment, say if there are some notifications, some benefits, to try and get that, and also to use advocacy. So then it's not just only about compliance and processes, but at the same time, you also take the maximum benefit while keeping your ethics and transparency, so that you achieve both the benefits of both keeping the shareholders' interests also, at the same time giving value to the business also.
Thank you so much. And as a closing remarks, I would like to say, let's embrace this moment not as a challenge, but as an opportunity. Make your organization not just the compliant, future ready, and that's what we've been hearing from all the co-panelists. Thank you so much for your time.
Thank you.